With transformational changes in the over-the-counter derivatives and swaps markets, with central clearing and the greater adoption of electronic trading of swaps, the question arises a lot around here of what new strategies might emerge in these markets. This is Paul Rowady, Senior Analyst with the TABB Group. I'm here with Kevin McPartland, Director of Fixed Income Research. Kevin just came out today with a new report that sort of goes into what might happen with these changes, and thought we'd talk about it today. What are the highlights of this research you've done?
Sure. So we went out and spoke with a number of principal trading groups about what their thoughts are on the swaps market, what potential strategies they see coming into play, and then what some of the potential roadblocks are in that market. It seems like a foregone conclusion that they will be involved as liquidity providers in the swaps market post Dodd-Frank. However, there still is enough regulatory uncertainty in certain places where, depending on which way the rules go, it could, there is the possibility that it could completely kill their entry into the market.
What, if we sort of separate and we jump ahead and we say, okay, what best case scenario, this becomes highly automated, more standardized, maximum amount of access.
Sure.
I mean, are the players starting to think about what strategies might be deployed, or are they just, the headspace isn't there yet?
Yeah, no, absolutely. So everybody's initial focus will be market making, providing liquidity. That's where most of the proprietary trading firms have sort of entered into some of the other markets as they've grown, and that's where they're going to enter into the rate and credit swaps market as well. One of the interesting findings that we realized was that swaps trading is not new to these proprietary trading firms. They are actually very, very active in the OTC energy swaps market, making up about a third of the overall volume in that market. So taking what they've learned there in that sort of OTC traded cleared market, they'll be relatively straightforward to take some of the lessons learned and move that over to the interest rate swap and credit default swap market. As you said, once the sort of more vanilla pieces of those markets become more automated and centrally cleared.
And what's the framework of the players? I mean, are these, just like the high-frequency traders firms today? Is this proprietary trading shops, hedge funds? Are those the main players, or are there?
Yeah, no. So, I mean, the report was absolutely about those proprietary trading firms, the ones that are big in high-frequency trading in equities and futures and options. We titled the report Higher Frequency Trading because, yes, the turnover in the swaps market will increase. Trading will be electronic, and it'll be much, much faster than it is today. However, at least not in the foreseeable future, we don't expect it to get to a place where the futures and equities markets are. They're just fundamentally different markets. But you're bringing up an important point. The major dealers will still play a huge, huge role as liquidity providers in the space. The market needs them and their capital to keep markets liquid and spreads tight, but the proprietary trading firms, as they have done in equities and futures markets, their liquidity provision will tighten spreads even further and ensure that there is always someone on both sides, sort of both sides of the on the bid and offer. But so some of the big hedge funds will come into play here as well. And it'll be, I think the end story is it'll just be a more diverse market of liquidity providers.
Now, one more question. When the timelines are changing in terms of when the regulations will be finalized, how quickly the adoption of clearing certainly, and then ultimately electronic trading venues and CEFs, and there's still a lot of question about what models those might take. So, I mean, we've got a bit of a timeline before we get really definitive guidance on what these rules are going to be, and then the implementation process. Is it indicative of something else in other markets that's going on, that the proprietary trading firms and the hedge funds would actually be spending so much time now, given that this is not likely to unfold over the next for another year or two, or are you seeing it differently?
Well, the timeline is the $600 trillion question, right? It's when are we really going to get there? And it seems to keep changing. It sounds like now the CFTC saying they'll have the rules done by the end of 2011. We now expect that the implementation will see clearing and reporting come in first, and then trading will quickly follow. So if we expect clearing mandates to start to take effect for some of the most vanilla products by the end of the first quarter of 2012, and then hopefully trading mandates will quickly follow in the second and third quarter of 2012. Even though it seems like, and that's a year from now, right? The end of the second quarter is a year from now. But if we think about how complex these rules are, that's not really that long to completely revamp, in some cases, either completely revamp your trading desk and how they trade swaps, or to create a whole new set of strategies from scratch. Right, a year is not a lot of time. So people are getting in, they're testing the waters, they're trying to understand how this will work in practice, and basically trying to decide if they think it will be profitable and how they can then make money in these markets.
That's good. The report is higher frequency swaps trading, just released today. This is Paul Rowady and Kevin McPartland. Thanks for watching.